Every kingdom swears that its money is safe. Every government claims its promises will last forever, and history exposes them as liars every time. From Rome to France, from the Confederacy to modern Lebanon, people have awakened to find their savings worthless, their salaries meaningless, and their futures stolen by systems they thought were unbreakable. Collapse is not rare. Collapse is the rule. The real question is not whether financial systems will fall, but how you will protect yourself when they do. The illusion of permanence is the most dangerous financial mistake. We look at our bank balances and national currencies and assume they are bedrock. But money is not bedrock. Money is trust, and trust can vanish overnight. This is why history is both cruel and useful. Every collapse leaves behind patterns, lessons, and warnings about what actually protects wealth and what crumbles into dust. Pay attention, and you'll notice that the survivors were not the ones who trusted the most. They were the first to doubt. Consider the Byzantine Empire, remembered as the eastern half of Rome that managed to survive nearly 1,000 years after the fall of the West. At the heart of its economy was the gold solidus, so reliable that merchants across Europe, the Middle East, and Asia accepted it without question. For centuries, it was the closest thing the medieval world had to a global reserve currency. But here's the part loyal viewers will appreciate. You'd think they had learned from Rome's earlier silver denarius disaster, debased into a tin-plated token by emperors who kept stripping out the silver. We've told that story before, but no. Centuries later, the Byzantines repeated the exact same mistake with gold. They began shaving its purity, thinning it out. Cheaper alloys were mixed in. At first no one noticed, then confidence cracked. The coin that had been the backbone of Mediterranean trade became just another political fiction. Its loss of value destroyed its credibility, and with it the stability of the Byzantine economy. What remained? Not the words written on paper, not government decrees. It was the merchants who quietly stored real gold or land beyond imperial reach, who preserved their wealth while everyone else watched their money evaporate. And here lies the first timeless lesson. Governments cannot resist the temptation to dilute their money, and when they do, real value flees into assets they cannot counterfeit. But not every collapse comes from rulers tampering with money. Sometimes it comes from shocks that appear out of nowhere. In the mid-14th century, Europe was struck by the most devastating epidemic in its history, the Black Death. Between 1347 and 1351, as much as half of all Europeans died. Cities emptied, villages vanished, trade routes broke, and yet the economic story of the plague is more complex than simple destruction. When half the labor force disappears, labor becomes precious. The survivors could demand higher wages. Food and land, once scarce, became relatively abundant compared to people. Families with liquid assets, silver, goods, or even just the ability to work, suddenly had unimaginable leverage. Properties that once cost fortunes became dirt cheap. If this feels disturbingly familiar, it should. We saw a modern version during COVID. Supply chains collapsed, governments printed trillions to prevent total shutdown, and a wave of inequality emerged. Those with liquidity bought assets. Those living paycheck to paycheck got left behind. U.S. housing prices soared. Stock markets recovered almost instantly, yet millions struggled to pay rent. The rhyme is unmistakable. Pandemics redistribute wealth. They always have. The survivors of the Black Death used scarcity to climb the social ladder. The liquid survivors of COVID bought homes, stocks, and businesses others could no longer hold. The lesson is harsh but true. Crises reward those with reserves and punish those without. While pandemics show how fast shocks can overturn an economy, the collapse of Renaissance Florence's banking sector shows something equally vital. Even institutions too big to fail can fall like dominoes. In the 1340s, Florence was Europe's financial capital, home to powerful banking families like the Bardi and Peruzzi. These dynasties had loaned enormous sums to kings, most disastrously to England's King Edward III during his wars with France. When Edward defaulted, the banks collapsed. Depositors were ruined. Trade froze. Florence plunged into chaos. Ordinary citizens who trusted these mighty institutions learned that size is not safety, and reputation is not protection. What did people learn? Too big to fail is a lie as old as finance itself. Institutions exist to make profit, not to guarantee your survival. When they fall, they take your savings with them. This lesson repeats every century, from Florence's bankruptcy to Lehman Brothers in 2008 to Lebanese banks freezing accounts in 2019. Survival belongs to those who understand that the promises of institutions are valid only until the day they end. The American Civil War is remembered for battles, politics, and the end of slavery. But behind the smoke and speeches was a brutal financial war most Americans today barely understand. Both the Union and the Confederacy discovered that a war of this scale required printing money. The North issued greenbacks, paper money backed not by gold, but by the U.S. government's promise. At first, this looked bold and patriotic, but the more the government printed, the less each dollar could buy. Inflation eroded trust. The South had it even worse. The resource-strapped Confederacy printed astonishing amounts of graybacks. By the end of the war, Confederate inflation reached almost unimaginable levels. Prices rising by hundreds of thousands of percent, wages buying almost nothing, and soldiers' pay becoming worthless before they could spend it. People carried bags full of money just to buy bread. By 1865, Confederate currency wasn't weak. It was dead. What mattered in this collapse were not the promises on paper, but physical assets. Land, food, gold, anything real, soared in value while money became a cruel joke. The winners were not the patriots holding paper. They were the opportunists who owned what the government could not print. The lesson Americans rarely hear but must never forget. Your country has already experienced a currency collapse, and when it happened, protection didn't come from trusting the system. France shows how revolutions can destroy money even faster than wars. In the 1790s, after overthrowing the monarchy and seizing church land, revolutionaries issued a new paper currency, the assignat. Backed by confiscated property in theory, assignats were supposed to stabilize the economy. Instead, the government printed them recklessly. Each issue weakened the last. Prices rose, wages lagged, and soon the assignat became worthless. Farmers refused to sell food for paper, demanding goods or silver instead. Bread riots returned. The revolution devoured itself. The winners were not the ones holding patriotic paper, but the ones owning food, gold, or property, the things a government cannot print. 2 centuries later, the same lesson resurfaced in Asia. In 1997, what began as a speculative attack on the Thai baht triggered a regional crisis. Thailand had borrowed heavily in dollars, believing its exchange rate would hold. When it collapsed, foreign currency debts became unpayable overnight. Investors fled. Southeast Asian currencies, Indonesia, Malaysia, South Korea, fell in a chain reaction. Economies shrank, unemployment soared, and governments begged the IMF for rescue. Those who suffered most were not the hedge funds that triggered the panic, but ordinary citizens whose savings evaporated and whose mortgages doubled overnight. The pattern was painfully familiar. Those holding assets abroad, in dollars or hard assets, survived far better than those trusting the local currency. A collapse that looked local was, in fact, a global transfer of wealth. The lesson is the same from Byzantium to Argentina. Borrowing in someone else's currency is a death trap. When the storm hits, the borrower drowns, not the lender. Now the picture should be clear. Revolutionary France, Civil War America, modern Asia, all share repeating themes. Paper money collapses. Debt chains both nations and families. And the survivors are not those who trust the system, but those who recognize its fragility before it breaks. The most chilling fact is this. Collapse is not ancient history. It is happening right now. If you like the video content, don't forget to subscribe to our channel and turn on channel notifications. In Lebanon between 2019 and 2021, banks did something unimaginable to most people in the developed world. They locked their doors. Citizens woke to find their deposits frozen, withdrawals restricted, and their currency losing over 90% of its value. Lifetime savings vanished. People lined up outside banks begging for access to their own money, and were told it was gone. This wasn't just small savers. Middle-class families, retirees, doctors, engineers, everyone who trusted the system was wiped out. The lesson was brutal and clear. Your bank account is not a treasure chest. It is a loan you give to an institution that may decide not to pay you back in a crisis. Those who survived best were the ones who diversified abroad, held real assets like gold or property, or kept cash outside the banking system. Everyone else was trapped. If this sounds unlikely to you, it shouldn't. In 2008, Americans watched their homes foreclosed and retirement funds destroyed, while the banks that caused the crisis were bailed out. In 2020, during the pandemic, trillions were printed to keep the machine running, blowing asset prices sky high while wages stagnated. In 2023, regional U.S. banks nearly collapsed overnight when depositors lost confidence, reminding everyone that too big to fail is a fairy tale we tell ourselves until the door slams shut. So how do you protect yourself when everything falls apart? History shows there is no single answer. In Byzantium, it was gold. After the Black Death, it was buying abandoned land, if you had liquidity. In Florence, it was not trusting too big to fail bankers. In the Confederacy, it was owning physical goods. In France, it was food and property. In Asia, it was avoiding debt and foreign currency. In Lebanon, it was leaving the banking system before the doors closed. The patterns change, but the theme does not. Survival comes not from blind trust in paper or institutions, but from recognizing what holds real value when illusions collapse. And here is the paradox that should wake you up. Collapse is both tragedy and opportunity. For the unprepared, it is destruction. But for those with resilience, liquidity, or unprintable assets, it is a time of acquisition. After the Black Death, peasants became landowners because there was too much land and not enough people to work it. After 2008, those with cash bought homes while millions were foreclosed. History shows that protection is not just defense. It is positioning yourself to claim what others are forced to abandon under pressure. But wealth is not only what you own, it is what you can do. The survivors of history were not only those with gold or property. They were those who could create value where others could not. The baker who could still produce bread. The craftsman who could repair tools. The farmer who could feed a community. The merchant who could move goods across borders. When money loses meaning, production never does. People must eat, build, trade, and live, and those who can provide these essentials never stay poor for long. This is the deeper form of protection. Not blind faith in institutions, not hope that governments or banks will save you, but a mix of real assets, real skills, and the awareness that illusions always collapse. Every crisis is a transfer, from the trusting many to the prepared few. From paper promises to tangible value, from passive savers to active builders. History has shown this pattern again and again. So the question is not whether everything will fall apart. It always does. The question is whether you will be among the many holding promises, or the few holding something real. History does not repeat, but if you ignore it, it will crush you just the same. If this gave you a new perspective, hit the subscribe button. History has the answers, and I'll show you where to look.